Hello, everyone, and thank you for joining us today for the first Manufacturing Council event, of 2023. Great to have you here. The North Carolina Chamber's role in manufacturing is we're the proud affiliate of the National Association of Manufacturing. Manufacturing is a cornerstone of North Carolina's economy with about 10% of our state citizens and about $100 billion a year in output. Clearly, what is made in North Carolina makes North Carolina. The Manufacturing Council was created last year as an avenue to bring together our state's manufacturers to talk about important issues. We explore workforce challenges, regulatory environment, supply chain challenges. While typically only open to our cornerstone members, this particular webinar today, we've opened up the first quarter meeting to all manufacturers because of the important topic and the distinguished guest we have with us today. If you're not already a member, as you engage today, I encourage you to consider joining our Manufacturing Council at the Chamber and taking advantage of the opportunities that come with a leadership role there. Our member network is impressive, and we have folks that are sharing important issues that can benefit your company and your communities, and adding your voice to to our member family as we look to become and continue to be the #1 state for business in the country. So we look forward to hearing from you. A few housekeeping items before we hear from our speaker. All attendees are muted today to avoid any distractions. If time permits, we will have some opportunity to answer questions. Please put them in the chat or come off mute and we'll get to them in the order that they come in. Today's session will be recorded and the slides will be shared in a recap email that'll be sent out later after this event today. Now, to get to our speaker, really important to have with us today Chad Moutray, who is the Chief Economist for the National Association of Manufacturers, where he serves as the NAM's economic forecaster and spokesperson on economic issues. In addition, he is the director of the Center of Manufacturing Research at the Manufacturing Institute, the workforce development and education partner of NAM, where he leads efforts to produce thought leadership, data analysis of relevance to business leaders in the sector. Prior to joining NAM, Chad was Chief Economist and Director of Economic Research for the Office of Advocacy at the U.S. Small Business Administration from 2002 to 2010. Mr. Moutray is Vice Chair of the Conference of Business Economists, and he's a former board member of the National Association of Business Economists, where he's the co-chair of the Manufacturing Roundtable. He is also former president and chairman of the National Economic Club, the local NAB chapter for Washington, D.C. Really privileged to have Chad with us today. And Chad, thank you for your time and for your leadership and for providing the information that helps all of our businesses continue to grow and thrive. So Chad, over to you.
Thanks, Gary. I look forward to the conversation today. Hopefully we'll have some time that you can share what's happening in North Carolina with some of your manufacturing members as well. But I'm going to share my screen here so you can see what I'm seeing in the larger manufacturing economy right now. So as was noted, I am Chad Moutray. I'm the Chief Economist at the NAM. I've been at the NAM for 12 years, and I straddle over into the Manufacturing Institute. So workforce topics are certainly something that we focus on quite a bit, and trying to find solutions there to some of those workforce challenges on the Manufacturing Institute side. So feel free to follow me on Twitter, or if you're an NAM member, you probably know me from my Monday economic report. So before I go too far into the slides, I'm going to kind of set it up this way, right? Because the reality is that manufacturing, it's a bit more gray than we might suspect, right? Yes, we continue to see purchasing managers index numbers and sentiment surveys in general, which are showing manufacturing contracting, right? We know that a lot of manufacturers and its consumers are worried about the economy and the economic outlook, and we see the global economy slowing, right? So you see all those more negative storylines, but at the same time, manufacturing employment has been very robust. You'll see in a second, the #1 issue continues to be workforce for most of our members, and wage growth continues to be pretty solid. And don't underestimate the role that all of that has in terms of if we're able to avoid a recession and have that soft landing that the Fed and everyone is seeking, that labor market, at least to my mind, is the key to that. So I'm going to set it up that way because, as an economist, you expect me to do a lot of on the one hand, on the other hand. And so I've already done that at the very beginning and kind of got that out of the way. But you are going to see a little bit of both, good and bad in these numbers. So let's do a little bit of bouncing back and forth between those. So we'll start here, right? This is the NAM Manufacturers Outlook Survey. We're going to be going back out in the field in the next week or so to get a sense of what the first quarter looks like. We've been doing this survey for 25 years, and you can see that over the history of the survey, about 3/4 of our members are positive at any given time. You can also see on this chart the recessions, right? The 3 recessions that we've had over that period. Notice that I do not have a recession for 2022 at any point, so that gives you a little spoiler alert where I see that happening. And I think the more important element here is that overall manufacturing activity fell below the historic average in the most recent survey that came out in December, right? So we had 69% of our members at the end of the year who were positive about their company's outlook. That is about 20 percentage points lower than it was at this point last year, right? And so we saw over the course of 2022, not only moving from more solid readings, but obviously the war in Ukraine, supply chain issues, inflation, worries about the outlook have all kind of taken a toll over the course of last year. And so we ended a little bit below where we were, in each of the prior quarters. And I wouldn't be shocked if this number continues to move a little lower as we get into the first quarter reading. Nowhere near, obviously, where we were during that worst part of the pandemic a couple of years ago, but still moving lower than historic average. Now, with that said, though, I think it's important to kind of keep all that in perspective. The reality is, especially when I'm talking to members, and I try to get out and meet with manufacturers as much as I can, is that mostly what we're seeing is not necessarily negative growth, right? I think what we're seeing is a slowing in the overall growth rate. So in that December survey, roughly 2.5% or so of our members said that they expected, that's what they expect the overall sales expectations growth would be for sales and production and capital spending, kind of in that mid-2 range, right, in terms of expected growth rates. And you see the other numbers up here as well. Again, weakening from where it had been in each of the prior 3 quarters, but not negative. And I think that's the reason why I'm showing you this chart, is that at least right now, I'm not seeing negative growth in terms of sales or production or any of these measures, which is encouraging. I mean, I've been at the NAM long enough to remember when we've had negative quarters. At least right now, that's not where we are. It's mostly just a slowing of activity or a weakening of activity that is pretty notable. The number one issue amongst our members is attracting and retaining a quality workforce. This has been towards the top of the list really for almost as long as I can remember. And the top 4 issues really haven't changed that much over the last couple of years. There have been moments, especially in 2022, where supply chain was number 1 or inflation was number 1. And each of those are really in the top 3. But we've seen supply chain and those inflationary measures move down the list to second and third place. Doesn't mean that they're not problems. You still have more than 60% saying it's workforce, supply chain, or inflation. But to the extent that you're looking for some silver linings here, it was good news that those moved a little bit further down the list. Now this is somewhat consistent with what you see in a lot of other sentiment surveys as well, where you're seeing, delivery times and freight costs and inventory levels, which are all trending in the right direction, even if they are still weaker than we might prefer. And so those are obviously good news. Even on the inflation front, you're seeing some moderation there, which we'll get to a little bit later on in this presentation. Still elevated, but some moderation of where we were. Now, I have gone out and asked our members really for the last couple of years, when do you think supply chain issues will get better? And you can see here that, roughly 11% of our members say that they already are better. And another 60% expect that those supply chain issues will abate or get better at some point in 2023. Now, I will add here that I do think, despite what the survey says, I do think that these issues are trending in the right direction, right? So that's the good news. And I think this question also really hinges on what does supply chain mean, right? if supply chain, the disruption is that you can't find enough workers or your suppliers can't find enough workers, that certainly is an issue that is more structural and one that certainly is going to be a little bit more persistent than you might think. If it's the chip shortage, right, certainly that is something that is more of a 2024 or 2025 solution, right? So those, again, is a little bit more structural than not. And I often get mixed messages here when I'm meeting with manufacturers. Some folks say that they're clearly better, maybe not where they were before the pandemic, but they've trended in the right direction, and costs are just over where they were before the pandemic. But so there was improvement there, even if they're not fully out of the woods. Other companies tell me that supply chain issues are still pretty significant and persistent, and that certainly is challenging them in terms of their ability to get the inputs that they need, or in terms of their overall production. So again, this is a bit of a mixed bag here. I do think that things are trending in the right direction, but there still are some lingering signs of issues out there. The good news there is that 60% of our members think that hopefully some of those issues will abate by the end of the year. The headline of the Outlook survey when it was released was this chart, which is that 62% of our members feel that we will officially slip into a recession this year. And you certainly see this out there in the media all the time. I've been hearing about a recession. I remember hearing members when I was talking to them last May, when I was in Minneapolis at that time, people asking me if I thought we were going to go into recession, if they should build a recession into their forecast or their budget planning for 2023. So I think for a certain extent, people have been talking about this for a while. In my view, we in some ways are talking ourselves into a recession, and I think that that's a real worry. I think that the constant drip of layoffs, particularly in the tech sector, is something that I'm watching pretty closely. But I do think that the risk of a recession this year is still out there. I don't think it's as high as 60% here. And I think that the risk of a soft landing is perhaps better than we think it is. But I do think this is a chart that is worth noting, because it certainly is one that I think folks are following pretty closely. And I want to get a sense of what you guys are thinking when we get to the end and into the Q&A. So moving away from the NAM Outlook survey into some of the other sentiment data that are out there, this is the ISM's Purchasing Managers Index. Pretty much every sentiment survey looks like this, right? Where this time last year, you had pretty solid growth in new orders of production. Those started to whittle away a little bit, but once you got to February and March, particularly with the Russian invasion of Ukraine, and you got to the summer months when people were increasingly more worried about the economic outlook, when inflation was very persistent, right? Those supply chain issues were still pretty significant. And so and then you get to the end of the year where the global economy clearly is weakening, continuing to weaken. So you get to a picture where in November and December and January, at the end of this chart, manufacturing activity was contracting. In other words, the PMI number was less than 50. And so you were clearly seeing not just a weakening of overall activity, but demand. You see here on the green line was really some of the weakest demand pictures that we've seen, really, certainly since the pandemic, but I think even over the last decade, it was one of the weaker readings. So you look at this chart and you say that it's pretty clear that overall demand has weakened as we ended the year and as we began this year, and that is again what you see in a lot of the sentiment surveys, but you also saw it in the manufacturing production data, right? So we ended the year with two pretty solid declines in manufacturing production, both in November and December, each of those over 1% in terms of the decline, and pretty broad-based in terms of the declines that we saw out there. So I'm going to flash forward a couple slides here just real quick and show you just how broad-based that was. You can see that in December, only really 3 sectors had positive growth in terms of their manufacturing production. That's aerospace, primary metals, and non-metallic mineral products. We had some pretty significant declines in almost every other sector. And that certainly is something that, again, speaks to the broad-based nature of it. And even when you look on a year-over-year basis from December of 21 to December of 2022, there's just a handful of sectors out there that where you saw positive growth. Obviously, aerospace is in a better place than it was a year or two ago, right? Everyone's flying. The sector is doing much better in terms of overall sales and activity, which is great. Motor vehicles, which was certainly challenged with the chip shortage in 2021 and early on in 2022, started rebounding towards the end of the year. So you see some positive spots up here, which I think are encouraging, and yet the bulk of these sectors had some pretty significant year-over-year declines. Now, again, I'm going to go back here because if you're looking for some silver linings to this data, right? We spoke quite a bit, for those of you who read my Monday economic report, about the resilience of the manufacturing sector over much of the last couple of years. And if you look and you go past, back before November and December, you can see that overall manufacturing production was pretty solid, actually. And we actually were seeing levels of production that we haven't seen in terms of that overall level since 2008, right? And so to me, there's a few charts in here which to me speak to that resilience and how companies were trying to increase their overall capacity over much of the last couple of years. So this is, obviously one of them. Capacity continued to increase at pretty solid rates. Manufacturing construction activity is, even though it pulled back a little bit in December, was just not far from an all-time high. And obviously the job openings pictures, all of those I think are signs, at least to me, that there was quite a bit of resilience in the manufacturing sector. And one thing that I hear when I'm talking to many manufacturers, even as they talk about activity that has slowed down or started to decline a little bit at the end of the year, is that you're building off of this really relatively strong base, right? And so yes, they're seeing declines, but on a year-over-year basis, in many ways, this activity is still positive and up modestly. And so, again, if that's it's a sign of some glass half full ness there, that is hopefully a little bit encouraging to you. We'll be watching this number pretty closely to see if those declines that we had in November and December continue to pull back in January when we get that data next week. The other data points that I like to look at is this one. So this is factory orders. And where I find this chart helpful, and it kind of goes to my comment a second ago about kind of pulling back from a strong base, is this is overall new orders and shipments for factory goods. And you can see that in the first half, it really was a story of two halves in terms of 2022, right? The first half of the year, we continued to see some pretty solid growth, both in terms of demand as well as in overall shipments. And then things started leveling out as you got into the second half of the year, and then started to pull back a little bit as we got to the end of 2022. Again, on a year-over-year basis, each of these numbers are still up modestly, at least. But again, it kind of speaks to the weakness that we were seeing at year's end. One kind of asterisk I'll put next to these data is this is obviously in nominal terms, and so part of that increase could simply be higher prices. But I think even outside of that, we saw some gains there. The other kind of comment to make is that one thing that I'm always looking at when I'm looking at the factory orders data is I'm pulling out this particular measure, which is core capital goods spending, which is defined as non-defense capital goods excluding aircraft. And you can see that number continued to hit all-time highs throughout almost all of the last couple years. And then it started to, much like the earlier data on the previous chart, started to tail off a little bit and start to weaken a little bit at the end of the year, but still not far from all-time highs. Now, why is this chart significant? It's significant because this is a proxy for capital spending in the U.S., right? And so when you're looking at overall activity in the larger economy, having continued strength here is a sign that companies are still investing in themselves. And I'm often asked in the media about capital spending, and one thing that I like to point out is that manufacturers in particular are very long-sighted, right? They're looking not just at 2023, but 2024 and 2025 and beyond. And most of them, even if they think we're going to go into recession this year, expect it to be a relatively mild one. And so they're already thinking about how can I set myself up for success in 2024 and 2025, right? So that helps explain why we continue to see relative strength in terms of capital spending, right? Companies are still investing in intellectual property. They're still investing in new equipment and new technologies, and why they continue to invest in people, right? Which is why the labor market continues to be as solid as it is. And so again, it's a bit of a split screen in that you do have the slowing of demand in some of the earlier charts, and yet you still have some of these other measures which are at or near record paces. So I'm going to turn now my attention to the global economy, because we're seeing very similar storylines when you look around the world, right? So this is the top 10 markets that we sell into. This is the top 10 as of 2021. I'll be able to kind of orderly rank these for 2022 very soon. But you can see here that of those top 10 markets that we sell into, 8 of them had contracting manufacturing sectors in the month of January. That's not unlike what we saw in the prior 2 months as well. We had a little bit of flipping here. Canada improved, but Mexico pulled back between December and January. But overall, 8 economies here which have contracting manufacturing sectors. And when I look around the world and I look at the challenges that are out there, certainly you have to start with China, right? And the fact that China has continued to grow weaker than we have become accustomed to. They grappled with zero COVID last year. They grappled with COVID more recently, starting to perhaps see some signs that activity is starting to peak up a little bit in some of the data, not so much on this chart, but in some of the other data points. And so, obviously, as goes China, so goes the rest of Asia, at least in my view. And so you're seeing weakness really throughout Asia and the emerging markets, largely because the global economy has slowed. Some countries continue to grapple with COVID, as I just noted with China. And also just in general, many of these markets are export-led economies. And so that's going to continue to provide some weakness there. In China's case, they also have a challenge in terms of demographics. Demographics are not their friend. And I would expect China to be growing slower over the next decade than we kind of have, again, become accustomed to. The other big challenge that's out there is Europe. And Europe is all about the war in Ukraine, the fact that continues to persist, the fact that overall energy costs and other inflation continues to be a problem. The good news in Europe's case is that we've had a warmer winter in Europe than we feared. And so that you're starting to see a little bit of moderation in some of those energy costs and other inflationary measures. And Germany, which was expected to contract in the fourth quarter, actually eked out a very slight gain, actually. But that uncertainty over how the war will play itself out over the coming months is going to continue to keep Europe weaker than we would like. Brexit also is playing into the UK figure. When you look at all of this, it's just a coincidence that the number 1 and number 10 are expanding. And India, in my view, which has been one of the brighter spots amongst the top 10 markets, is benefiting from friendshoring from China and other pockets of Asia more than anything else. And so that's really what's moving the needle on that particular figure. Well, now I'll give you a glass half full version here, and that is that even though we saw 8 markets contracting in January, you did have a number of markets that actually improved between December and January. And so that hopefully is a sign that we'll see some progress here. And you did have the World Bank that upped its forecast for global growth as a result of some of the improvements we've seen in the last couple of months. And so that provides a little bit of encouragement, perhaps. The other thing to watch on the global side is that the dollar, if I were giving this presentation 6 months ago, I would have talked quite a bit about the strength of the dollar and how that really was challenging export markets, et cetera. We have seen since October, though, the dollar has decelerated pretty dramatically, largely, at least in my view, on the Federal Reserve's expected pivot, right, when they're going to start hitting the pause button. And also the fact that I think other central banks, while we have been raising interest rates, they've been keeping pace with us. And so that has actually helped. And you've seen the dollar pull back, as you see here, 7% since October and on a trade weighted basis. Obviously, if you're looking at specific currencies, if you remember, if you go back to before October, the dollar was at parity against the euro and against the pound, and you were seeing kind of record strength against the yen and other currencies. So we've seen some pullback in that, which is obviously pretty welcome news especially for manufacturers who are trying to grow their export markets. So the bright spot, and we're going to do a number of charts here on the employment sector. So the bright spot in the economy has been jobs, right? And so you see this this particular chart. You see everyone obviously remembers Friday, and we had that really strong 517,000 jobs number. No one was expecting a number that strong, and so that that obviously plays into a lot of things, including what the Fed might do. But it continues a trend of really solid labor market growth. And in fact, the unemployment rate, as you heard last night in the State of the Union, the unemployment rate fell to 3.4%, which is the lowest since May 1969. So again, we're still in what we economists call full employment territory, so very tight labor market conditions. And again, we'll talk quite a bit about this in a second, but just how difficult it is to find workers right now is exacerbated by that challenge. I do expect the labor market will cool over the coming months. So look for at some point later this year, the unemployment rate, drifting over 4%, right? Maybe up to 4.5%, but I think probably more likely someplace closer to 4-ish%. So you have to juxtapose that conversation, worries about a recession with what I just told you about where I see the unemployment rate going, right? It's kind of hard to square those together, right? The fact that you could have an unemployment rate that is 4, maybe 4.5%, and still have a conversation about a recession. There's a disconnect there, right? Which is pretty notable, and why so many folks, including myself, think a soft landing it might be more likely given that scenario. Go back to the Great Recession. You see the overall unemployment rate peaked out at 10, and so the fact that we'd be talking about 4, maybe even 5. Would still be pretty unique. Now, I will put an asterisk after that, though, and say that one difference here is that the labor force participation rate continues to be well below where it was before the pandemic. We've had a lot of folks who have moved to the sidelines for various reasons, right? We've had accelerated retirements. Childcare continues to be a pretty significant issue for a lot of parents. Immigration plays into this conversation in terms of legal immigration, where certainly that is a challenge for the U.S. Little side note there, the Canadians love it. The immigrants that are not coming to the U.S. are going to Canada, so they're certainly benefiting from our lack of having immigration policy there. But you also have just other issues there of folks moving to the sidelines. So we're trying to figure out how we can move them back in, including men and other categories where they just haven't come back to the degree we would like. In my view, also self-employment and entrepreneurship potentially play into this conversation. I don't think we're going to get back to pre-pandemic levels of labor force participation. We're about 1 percentage point below where we were before. And so that's going to continue to exacerbate that skills gap and workforce challenge moving forward. On the manufacturing side, we also have had very solid job growth over the last couple of years. We added just shy of 400,000 workers last year, 19,000 obviously in January, which was pretty solid. And over the last 2 years, both 2021 and 2022, we've actually added more manufacturing workers in those 2 years than we have since 1983 and 1984. Again, that's a talking point that Biden used in his State of the Union last night. So again, a very, very solid overall manufacturing job growth. And as a result, we actually have more manufacturing workers today than we've had since November of 2008. We are just shy, 1,000 workers shy of hitting the 13 million mark, right? So we now have essentially 13 million workers in the manufacturing sector. So again, go back to my earlier comment, we're even if we see some cooling in these numbers over the coming months, which I would expect, we're building off of that pretty strong base of having roughly 13 million workers in the sector. The other comment to make there is that job openings continue to be very highly elevated, right? We have 764,000 job openings in manufacturing. That figure has averaged 840,000 over the last 12 months. So very elevated levels of postings, right? Manufacturers are still going out and looking for more talent at a pretty elevated rate. We have seen churn kind of slow down a little bit, right? Quitting has been a challenge over the last year. We saw record levels of quitting, both from manufacturers as well as the overall economy over the last year. That has cooled off a little bit, but still at pretty elevated levels, right? We have still more than 4 million Americans who quit their job in the month of December. So again, those are just unheard of levels of quitting, right? And so that churn, right, helps fuel more job openings. And it also helps explain why so many folks continue to really struggle with finding workers. We know also that there are more job openings than people who are actively looking for work. And so this chart really speaks to that, right? So we have 11 million job openings in the US right now, and 5.7 million unemployed Americans. So we're almost at a 2-to-1 ratio, right? It's like for every 100 job openings, there are only 52 people who are unemployed, right? So that gap has continued to widen, right, over the last year and a half. And again, it explains why, you can just drive down the street and you see that wage growth is pretty significant. Even in the service sector, you're seeing wages that a few years ago would have been unheard of. Signing bonuses, just a whole host of things, right? And so it's not just a manufacturing phenomenon. Every sector is scrambling for workers at this moment. And that's certainly pushed up wages, right? So I hear from manufacturers all the time who tell me that they've had to raise wages, especially for entry-level workers, but for other categories as well, several times over the last couple of years to stay competitive, right? In January, the average manufacturing production worker nationally earned just shy of $26 an hour. It was $25 and I think 81 cents or 83 cents. That's up 5.3% year over year, right? So very elevated levels of wage growth, right? That's certainly moderated a little bit from where it was earlier in the year, but still pretty elevated levels of wage growth. And the big challenge, I think, for many manufacturers is that we've seen even faster growth in some of the other categories, right? Service sector workers, hospitality, other places. And so while we still pay more than most of those sectors, you've seen that gap narrow a little bit. And that's really has become the challenge for many companies in terms of getting those entry-level workers. The other challenge that's there is that while 5.3% is a pretty healthy number, we all know that the consumer price index is up by more than that. And so in real terms, or in purchasing power terms, those numbers are negative. So, I think this certainly plays itself into the political conversation, the inflationary conversation, et cetera. And again, something I'm sure that many of your companies are grappling with. So that's a good segue into talking about inflation. So I have 3 charts here to talk about inflation. I always start with this chart. This is the PCE deflator, the personal consumption expenditures deflator. That's just a fancy way of saying the price index for personal spending. And the reason why we always start with this chart is this is the preferred measure of inflation from the Fed. And so when Jay Powell goes out and gives a speech, as he did yesterday and last week, you'll hear him say that he wants core inflation to be 2% over the long term. Well, that's essentially the red line here. And you can see that we are nowhere near 2%. In fact, I don't expect us to get back to 2% this year. And we might get closer to it, I suspect, when we get into 2024, but we're still quite a ways from that. And this explains why the Fed has been as aggressive as it has been over the last year. We could obviously argue that they should have started raising rates sooner, and I would agree with that. But if you go back to this point last year, the Fed funds rate was effectively 0. They have raised rates pretty aggressively since then. They just raised rates 25 basis points on February 1st. And today that range for Fed funds, the upper bound is 4.75, right? So you've gone from 0 to 4.75 in a very short period of time. And I see them continuing to raise rates 25 basis points at their March meeting, another 25 basis points at their May meeting, and then hopefully they'll hit the pause button at that point, which would bring the terminal rate up to 5.25. So that's where they are, right? The Fed, in order for them to hit the pause button, they're going to have to continue to see some continued moderation of some of these pricing pressures, as well as perhaps some moderation of some of the wage pressures. Now, the good news here is that you have seen some moderation of inflation, and you can see that here in these year-over-year charts. First, with the PCE deflator, especially at the headline level, the blue line. You see it even more so when you look at the producer price index. Again, still pretty elevated, but showing some signs of moderation. And then at the consumer price level, we will be getting new consumer price index data for January next week. So that'll be a very closely watched number. And what's pulling the headline inflation down here a little bit is the fact that energy costs have come down pretty dramatically since they hit an all-time high in June. But still, you see overall core inflation at the consumer level is still pretty elevated. Rents continue to be pretty high. Transportation services, food costs, all of those continue to keep inflation at the consumer level pretty elevated. I kind of transition to this chart. This is consumer confidence. This particular measure is highly correlated with gas prices. And so it perhaps is appropriate that I'm doing it right after the consumer price index. You can see that we hit an all-time low for consumer confidence in June when we had an all-time high for gas prices. And they've bounced back a little bit since then, but they're still relatively, they didn't bounce back as much as you might have expected. Consumers also are worried about the economic outlook, and I think that plays itself into this figure. And we did see, weaker than desired retail sales numbers at the end of last year as well. So let's talk about the forecast. And so we have these last three charts, and then I'll do Q&A. So the first here is just an acknowledgement that we ended the year, both in the third and fourth quarters of 2022, with some pretty solid GDP numbers. Now, a lot of things are going on behind the scenes here with inventories and supply chains, et cetera. But we did end with 2.9% growth in GDP, which is pretty encouraging. People were getting out and about, and that certainly helped on the service side in terms of consumer spending. Net exports have played into these numbers as well. And so, yes, we did have declining GDP in the first half of the year, but we made up for that in the second half of the year and kind of grew around 2% overall in 2022. Now, that is a bit of a high water mark, and because as you see here, my forecast for this year is much lower, right? The current quarter I have about a 0.5 percentage point up here. It's probably hovering between a 0.5% and 1% right now, depending on what forecast you're looking at. And this particular forecast is essentially a soft landing scenario, right? I could easily put a negative number up here. I haven't, but I do think we're going to see softer growth this year, and hopefully starting to come out of that as you get towards the end of the year. Now, let's talk a little bit about the upside and downside risks, because there still are more downside than upside risks here. One of the bigger downside risks, obviously, is the Fed. And the fact that monetary policy takes a long time to work its way through the system, right? And so that risk is still out there, and hopefully the Fed does hit the pause button soon, and it starts evaluating where the lay of the land at that point. But that certainly is a huge risk that's out there. You have obviously the war in Ukraine. You have slower global growth. Rising inventory levels is something that I'm watching. You hear that a lot more on the retail side than on the manufacturing side, but certainly something that I'm watching. And then there's always the risk that we are talking ourselves into a recession, right? And so that to me is also something that I think is significant, and certainly something I've been following over the last few months. On the upside risk, though, the labor market is key, right? If we get that soft landing, right, where we eke out slight growth but not negative growth, it's entirely because the labor market continues to be strong. It means wage growth continues to be strong, and people are still spending despite some of those recessionary worries that are out there. The other big upside risk is the fact that we have a lot of infrastructure dollars going out the door. You still have the chip foundries that are being built. You have for some reshoring that's taking place. So I think all of those are going to continue to provide some tailwinds to the economy, either giving us that soft landing or, to the extent we have a recession, making it a much milder one, right? In terms of manufacturing production, I do continue to see some weakness here at the first part of the year. Overall, manufacturing production will likely be down slightly this year, but starting to come out of it by year's end. And my forecast for 2024 would be for roughly 2% or a little bit less than that growth in manufacturing production. So that's an awful lot there, Gary. I saw you came on the screen, so you saw that I was getting towards the end. There's my contact information, and I will stop sharing my screen so I can take your questions.
All right. Well, first of all, Chad, thank you. Really, really helpful, and appreciate all you're doing to present that information, analyze it, and keep us abreast of what's happening and how manufacturing is affected. So thank you very much. The chat room is now open. You could either enter questions into the chat, raise your hand, and Dana on our staff will be recognizing you and getting the questions over to Chad. So with that, I'll turn it over to Dana.
Okay, we have a question in the chat box. You showed in one of your early slides that your members' growth forecasts were much stronger for domestic opportunities than with exports. How long do you think weakness in more global demand can last before affecting the U.S. more strongly?
So that's a great question. I mean, I think one of the bigger challenges over the last couple of years has been the U.S. was growing a lot faster than the rest of the world, right? And so that you saw yesterday that the trade deficit in 2022 hit a record high, right? A large part of why the trade deficit hit a record high was that because the U.S. has fared better than the rest of the world, we bought more stuff, which meant we bought more imports, right? Whereas the rest of the world, that export growth was relatively not as robust, right? So that continued to increase the size of the trade deficit. The other elements obviously that affected that record number were petroleum prices and the dollar and supply chain kind of volatility throughout the year, but that certainly played itself into it. I do think that we want to see the global economy grow, right? We need a stronger China, we need a stronger Europe, we need stronger markets in general, because that helps grow our exports. So the fact that we've seen some downgrades in global growth over the last 6, 7, 8 months certainly does not speak well to our ability to grow our export markets as much. There was that silver lining though. In the last week or so, the World Bank said, hey, well, maybe some of the moderation and inflationary pressures and some other signs of some strengthening, maybe the forecast for global growth will be slightly better than we thought a few months ago. And so I do think that you are going to start to see China start to improve a little bit over the coming months, which is good, right? That will certainly help Asia, it will help the emerging markets, maybe even help commodity prices. And to the extent that we can continue to see some improvements in the U.S. too, I think that will help grow the overall economy. But all of that, what you just described, has played into that trade deficit number and played into really what we've seen in some of the economic data over the last couple of years.
Thank you. We have another question. Is the data connecting with how the manufacturers in North Carolina are feeling?
Well, I would imagine so. I mean, obviously I'm talking from a national perspective, but I do get out and about and talk to a lot of manufacturers, and it's pretty consistent wherever I go. I think, and maybe I could turn this question around and you guys could tell me, but I do consistently hear about slowing demand, right? The global uncertainty in terms of the overall economic outlook. But everywhere I go, they tell me they can't find enough workers, right? That worker shortage is pretty pervasive. Wage growth continues to be very solid, right? And even with raising wages, companies still can't find the workers that they need, right? They've had to turn away work, right? They might want to add another shift, but can't because they can't find the workers for it. And so that again is a bit of a split screen, right? You have these worries about the outlook and slowing demand at the same time. The number one issue, I'm sure in North Carolina as well as everywhere else, is that worker shortage is real.
Any other questions, raised hands, or thoughts you want to put in the chat for Chad while we have him today? Dana, are we seeing anything? I can only have limited view. Do we have anybody else?
No, that's it so far.
So Gary, I'll turn the question around to you. Is that pretty consistent with what you're hearing in North Carolina?
Yeah, I mean, it's commonly talent, and talent are the three biggest challenges going forward. We're very, the state's doing well mostly. Our non-urban areas have different challenges than our urban areas, but it's about talent for sure. And I think what you put in your slides is really reflective. And, we have a number of our folks on here that are on our membership and our leadership that could add it, but I'm not seeing anything there that isn't the same challenges that we're facing.
Would you argue that, because I would argue over the last 3 or 4 weeks, the soft landing scenario has starting to gain a lot more traction. I remember I spoke at a meeting at the beginning of January where I used the soft landing word and people said I was more positive than they thought. But that has started to gain favor, which is hopefully a good sign.
Yeah, I think that our state and the planning that our businesses and our elected officials have done over the last 10 years has allowed us to be a little bit more resilient and land a little softer in North Carolina. So I think our folks in the finance industry and those folks are saying, yeah, we're going to feel it. The next interest rate hike will make us even feel a little bit more, but we're going to land okay.
Yeah, good. So I think another question came through. I can't see it because
Yes.
of a glare on my screen, but
Derek, feel free to go ahead.
All right, thank you very much. Chad, thank you so much for this information. I work with Glen Raven Inc., and we are a global textile manufacturing, but most of our manufacturing is done in North Carolina and South Carolina. A lot of the data that you're providing speaks true for us as well, but yet we continue to see that big bubble in the inventory supply chain. And so when I saw your comments about, or your data on the 12% decline, I think it was in the textile industry, are you seeing anything that would be a causation beyond that? Because we seem to feel that it's more that inventory buildup as people are bringing their inventories down to more reflect the demand out there.
yeah, and I mentioned earlier the retail side. We're seeing a lot of excess inventories on the retail side, and I suspect a lot of that's in the textile space, but not only in the textile space. And so yes, I've heard a lot about it. I'm going to be with a bunch of economists the next couple of days, where I'm sure I'll hear even more about that consumer and retail side. But I've also heard about rising inventories, just writ large. For other manufacturers as well, right? The worry there is that why are inventories creeping up? I mean, I think companies have been keeping a little bit more inventory on hand anyway, just to avoid having any production disruptions. But to the extent that those inventories are creeping up because demand is not there, or maybe the other customer is not selling as much. That's a red flag for a possible downturn, right? So I want to continue to watch that closely. I don't think for the manufacturing sector it's pull your hair out on fire on whatever yet, but I do think they have been rising, and so I think that's a red flag we want to continue to watch. And obviously the retail side, that certainly is one that I think the retail sector is watching even more closely.
We have a couple more questions. First one, what percentage of manufacturers are you seeing adopt new labor strategies to make ends meet, avoid turning down orders, and accurately meeting demand, i.e. part-time labor, gig economy labor, altering employee schedules, etc.?
Well, so I know that 45% of our members have had to turn away work because they don't have enough talent. On the gig conversation, hey, you should reach out to me because we're getting ready to do a study on that very topic to see what best practices are out there and what companies are doing to embrace gig work, and we're really interested in what companies are doing as it relates to flexibility, right? And so if you have ideas there or best practices, email me so we can kind of pursue that. I think the other big thing that companies are doing, and we wrote quite a bit about this on the Manufacturing Institute side last year, is the companies are having to differentiate themselves against their competitors, right? I mean, we're competing with Amazon, we're competing with McDonald's and Walmart and FedEx and everyone, a lot of other companies that you might not, I wouldn't call them traditional competitors yet. We are competing against them. And so how are you as a manufacturer differentiating yourself, right? It's not just wages, right? It's culture, it's professional development, it's making a difference, right? It's a whole host of things that companies are saying, hey, this is what you can do for us that you can't do by working over there. And so I think those strategies have been effective, right? And certainly ones that we're going to continue to look at. We are trying to stand up a solution center on the Manufacturing Institute side where companies that are struggling with certain issues will hopefully be able to see a series of resources that we have in that space. And so stay tuned for that. But again, if you have best practices or ideas of things that are working for you, let me know, because I think we're trying to track that as much as we can. Especially on gig, because I want to know more about what companies are doing in gig. Because I'm not sure I fully understand everything that we can do there, but I think that's a topic that we're going to pursue, I think, with PwC in terms of a new research study.
Thank you. I have a few more. Regarding the worry about attracting, retaining workers, do you believe it's more that folks looking for work don't want what's available, i.e. rotation, 7-day nights, or that organizations are having trouble finding talent meeting their needs? Wondering if it's more about incentives or education training.
It's a little bit of all of that. I mean, obviously manufacturers struggle with perceptions, right? People don't, even if you get laid off, do people think of manufacturers? And so perception continues to be a problem, right? I would often say that at the beginning part of the pandemic, it's like, well, that person that just lost their job at Macy's, what are you doing to get them in the door? And then like, well, first off, they got to think of us, right? Because people have, perceptions about manufacturing which are outdated, and we gotta change those perceptions. I do think people have also, because of the pandemic, reevaluated work-life balance and priorities, right? And so I think that plays into it. Childcare is a big issue, right? And there was a good story in the Wall Street Journal about it yesterday. I hear about it all the time. There are places in this country where there are childcare deserts. And so companies have had to find kind of creative solutions to that. So I think those are issues. We also have to look at the larger labor force, right? The reality is the labor force has changed since the pandemic. Not to be morbid, but we lost 1.1 million Americans from COVID, right? Many of those were working age. Most of them were over 55, right? And we so there's that element. We also have seen a lot of accelerated retirements, right? And going back to the gig conversation, I kind of made a comment earlier about men. Young men, for whatever reason, have not come back into the labor market to the degree we would have thought. And what percentage of those are doing gig work? How many of them are driving Uber Eats? How many of them started up their own business and became self-employed? I think those are all legitimate questions that we're trying to get to the bottom of. I think it helps explain how we might get people back, but also where they went.
Thank you. What percentage of manufacturers are making AI and digitization a priority to help ease their labor pains?
Well, I know, every company's looking at these technologies in different ways. I think that was true even before the pandemic. And certainly given the labor shortage, I think more companies are looking at ways that they can use technology more creatively, especially for some of those harder to fill or harder, more tedious roles. There were more robots purchased last year than in any year ever, right? And so that certainly speaks to the embrace of new technologies. I think AI is just another one of those that is going to change the way we think about production, but there's a whole host of disruptive technologies. That quite frankly does a couple things though. I mean, number one, it helps make the sector more productive. But it also, what I found is that, companies are struggling to find workers anyway. No one really is getting fired. So the notion that robots are taking your jobs away, that really has not been true, at least from the companies I've spoken with. And if anything, it actually exacerbates that skills gap challenge, right? Because you now have manufacturers who are competing for talent with Silicon Valley and other places. Everyone's competing for the same type of worker, right? And so that makes that tougher. And it also means the workers that you have, it further necessitates the need for more upskilling and training. And so, yes, is the answer to your question. I don't have an actual percentage, but yes, almost everyone I talk to is doing it. And it has ramifications that kind of spill off of that for productivity, but also for training and for hiring.
Thank you. I think we have one more. You spoke about company investment at high levels. Is that trickling down to smaller manufacturers? Technology adoption, it's very important to address some worker shortages.
Yeah, I mean, obviously the small and medium-sized companies are a little less along the life cycle there in terms of embracing of new technologies. I think every company is looking at their supply chain differently. I think every company is looking at technology differently than they were before. But companies, especially small and medium-sized companies, have a lot, they don't have the resources or the time or the scale or scope to embrace them as much as some of the larger companies. It doesn't mean they aren't going to. It just means that there are priorities, and in a world where costs of everything are going up, that embrace is perhaps a little slower than it would be for some of the bigger companies. But I think they're all doing it.
Thank you. Gary, do we have time for one more question?
Yeah, we have 4 minutes, so we'll stop. And I just got a couple closing remarks, but we have time for one more. If Chad does.
Have you seen any creative solutions implemented by employers to reposition potentially underutilized portions of benefit packages to attract and retain new employees effectively?
No, that's a great question. I mean, we did a study last year on compensation, which if you email me, I can send you. It's on the Manufacturing Institute website, and benefits were certainly part of that conversation. Certainly, insurance is an important part of that as well, but so is leave and a bunch of other things. And so I might turn your attention to that study. But yeah, I think companies are looking in general at their entire compensation package, whether that's benefits or pay, and seeing what they can do to improve that, to make sure that they are competitive with other local competitors, but also attractive for a whole host of generations. I will tell you that younger workers perhaps are less enthralled in some of the old, I'm the older ones like me, with some packets there, but we got to make sure that we're looking at packages that are attractive to all, various generations.
Right. Well, Chad, we're coming right up on the time, and I want to thank you again for taking an hour today to be with the folks and the manufacturers in North Carolina. We value our relationship with NAM a lot. So thank you for your time today. Thank you for all the attendees. Appreciate you getting on the call today. What's made in North Carolina makes North Carolina, and we appreciate what you do for your communities every day. And so look forward to hearing more and talking with you more. Just a quick reminder to our guests today that the North Carolina Manufacturers Council, Chamber Manufacturers Council, is open to all of our Cornerstone members. Gives an opportunity for folks to come together, share best practices, talk about some of the challenges you're facing, and it's incredibly helpful to us as we advocate on behalf of manufacturers and businesses in North Carolina. We're going to provide a way for our guests to inquire about join the Manufacturers Council in the email that will go out tomorrow that has the information. They'll be recapping this event, so stay tuned for that. Before we close out, there's going to be a survey to complete about your experience today. I see it just popped up there. Please take a couple minutes to do that for us. It really helps us to continue to provide great programming. We have some events coming up, which are on your screen right now. Love to see you there. Have the opportunity to meet with folks and engage more. We're only as good an advocate as we are of you telling us how we're doing and what we need to be working on. Thank you for joining us today. We're going to continue to work on your behalf and be safe. And what's made in North Carolina makes North Carolina. Thank you all for what you do every day.